Hi, my name is Deanna, and today I'm going to be talking about the T account with your debits and your credits. In accounting, there is a system in place for recording transactions. These transactions are placed in a T account. A T account is where every transaction is recorded for financial records. Those financial records include your balance sheet, your cash flow statement, income statement, and your stockholders' equity statement. There are two sides to the T account. One is the debit side, one is the credit side. Any accounts on the debit side are going to have a normal balance on the left-hand side. Any accounts that are normal balances with credits are going to be located on the right-hand side. I will get to that in just a minute. This is often referred to as a double entry accounting. While every transaction is going to include a combination of accounts, each and every transaction must always have one debit account and one credit account. These are going to balance out that T account. That is very important. Debits and credits are formal bookkeeping and accounting terms. When I first heard of a debit and a credit, in my head, I was thinking of a debit card and a credit card, where you use your debit and your credit card to make purchases, which is going to decrease your amount in your bank account. Well, I had a hard time understanding this and rationalizing this, because to me a debit, meant a decrease in my bank account. But in accounting, a debit is actually increasing that T account. You would think that a credit would increase it and a debit would decrease it, but it's the opposite for the asset account. That's where my confusion was coming into play. Once I got into it and I finally realized that the debit credit in accounting was just a terminology. I just had to go and remember what accounts had a normal balance of a debit and what accounts had a normal credit in them for them. Here I am showing you a diagram of what a T account may look like. A T account for the assets, a T account for the expenses, cost of goods sold, and losses, T account for owner's draw, stockholders' equity. These accounts here on the top all are showing the debit side that are increasing the T account, which are normal balances for these accounts up here. Down here, I'm showing what the normal balance is for the credit side of your T account, which are your liabilities, your revenue, income, gains, and your owner's capital and investments. When you're making a transaction on your T account, you have to use one of these accounts. You have to use a debit side and you have to use a credit side. But just because this says it's a normal balance does not mean we're not going to use this credit side. A debit side with this normal balance is going to be the increase. Think of it as a deposit into your bank account. That's going to increase this account. When you go to pay a bill, you're going to decrease this account. So it's going to be a credit on this side. So you are going to be utilizing both sides of the T account. Just remember that a normal balance is going to be a debit for these up here, and a normal balance for these accounts are going to be a credit. I do have an example for you to show you how this is going to affect a T account. Mr. Jones is the owner of ABC Sensors, and he's going to invest in his company. Well, he's going to take $10,000 and he's going to invest it in his company. So he's going to be making a deposit into his bank account, which again, a bank account is an asset. So we're going to debit that because we're increasing that account by $10,000. The owner's investment account has a normal credit side. So we're going to increase that side of the T account by $10,000. So we have a debit to the checking account for $10,000 and a credit to the owner's investment account for $10,000. My next example is going to show you what an owner's draw and how that's going to affect the T account. 2 weeks later, Mr. Jones needs $2,000 as an owner's draw. Remember earlier I was talking about the cash account, which is an asset account. The normal balance is a debit to that account. That's when we're increasing that account. But now we're taking money out and we're going to give this owner some of his money back. So we're going to credit the checking account by $2,000 because that is going to decrease the T account. And for the owner's draw part down here, we're going to debit his account by $2,000 because we're increasing that account. The last example that I have is where Mrs. Jones needs to pay the utility bill for July in the amount of $300. Again, we're taking money out of the cash account, so we're decreasing that account. So we're going to credit that account by $300. A utility, for this T account, I've named it utility, but it actually is going to fall under the expenses. Expenses are going to have a variety of different accounts, such as your office supplies, interest, auto, fuel. There's all sorts of different expense accounts. So what we're going to do is we're going to be paying that bill of $300. So we're going to debit that account by $300. Thank you very much. Have a good day.